There's one banking setup most NRIs have never even heard of, and it's quietly costing active traders between 50,000 to 2 lakhs every single year. Not in taxes, not in losses, in brokerage fees, reporting charges, and trades they couldn't even make. Same trades, same stocks, same broker, just a different account structure. It's called a non-PIS account, and even a lot of chartered accountants who advise NRIs don't explain this clearly because the difference sounds too small to matter until you run the numbers. In the next few minutes, I'll show you exactly how much non-PIS saves, when it works, when it doesn't, and the one mistake that keeps most NRIs stuck on the expensive setup for years. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. This is Finicky, where I simplify money the same way I practice it. Let me tell you about someone I'll call Rajat. Rajat is an NRI based in the US, software engineer, 2 kids. Every weekend, he spends an hour managing his Indian investments. For 4 years, he's been investing in Indian stocks through the PIS account his bank recommended when he became an NRI. Every trade routes through his PIS designated account. His bank reports it to the RBI daily. He pays a reporting charge per trade. His brokerage is around 200 rupees per order. Funds move from his NRO account to his PIS account before trades execute, and occasionally there's a lag. For 4 years, Rajat assumed this is just how the system works. Until last month, when his cousin, another NRI, casually mentioned he's been paying about 50 rupees per order on brokerage. Now, it's the same broker for the same stock, and Rajat thought he had misheard, but he hadn't. His cousin isn't using PIS, he's using NRO Non PIS account. Here's the math that kept Rajat up that night. And a quick note, Rajat is an active trader, which is what makes the numbers land this hard. If you trade less, your savings are smaller, but the structure still applies. Rajat makes roughly around 120 trades a year. And at 200 rupees per order versus 50 rupees, that's an 18,000 in brokerage he didn't need to pay each year. Over 4 years, that's 72,000. At PI's reporting charges of around 100 rupees per trade rate, that's another 40 to 50,000. Beyond all this, factor in F&O and intraday trades his cousin could make that Rajat couldn't. Opportunities that Rajat never even considered because PIS blocks them. Rajat is now looking at roughly 1.2 lakhs of cumulative cost he paid for a structure he never needed. Let the numbers sit there for a second, and here's a part that really hurts. His banker never told him, his brokers never told him, his tax consultant never told him. They all assumed PIS was a default because for most NRIs walking into a bank, it is. This is why non-PIS exists, and this is why we are talking about it today. So what exactly is a non-PIS account? Screenshot this line if nothing else. Non-PIS isn't a new product, it isn't an exotic instrument. It's essentially your regular NRO account linked to a demat and trading account used to invest in Indian markets without going through the PIS framework. You're not bypassing regulations, you're using a different route, one that behaves much closer to a regular resident trading setup. No separate PIS ledger, no daily RBI reporting on every trade, no extra per trade reporting fees. And because this setup sits on top of an NRO account, it does more than just trading. It handles Indian rental income, dividends, pension payments, own a property back home and want to collect rent. That flows through this account. Drawing a pension, the same account you can use. One setup, multiple jobs, no RBI approval needed. Walk into your bank account, complete the NRO account KYC, link your demat and trading account, and you're done. If you're watching this thinking, I am Rajat, you're exactly the person I made this video for. Hit the like button and subscribe. It helps this video reach next Rajat who's quietly overpaying without knowing it. Now, let me show you why Rajat actually lost 1.2 lakhs. Benefit 1 of using a non-PIS account. Under PIS, your fund sits in a designated PIS account. Every trade flows through that ledger. The bank reports it daily to the RBI. Each trade carries reporting charges, and fund movement between your NRE and NRO account and the PIS account adds lag. Under non-PIS, that entire operational layer disappears. No separate ledger, no per trade reporting fees, no extra fund routing. The numbers are stark, as of September 2025, Zerodha dropped non-PIS brokerage to 50 rupees per order, while PIS brokerage still stayed around 200 rupees. That's a 75% cost difference on every single trade. Multiply that across a year of active trading, then multiply it across decades of being an NRI. For the record, PIS trades do execute in real time on the exchange. The bank isn't approving each trade, but everything around the trade, the ledger, the reporting, the fees, the fund movement is heavier. And that weight has a price tag. Benefit 2, this one is underappreciated, and in Rajat's case, probably the most expensive one. Under PIS, the intraday trading isn't permitted, short selling isn't permitted, F&O access is limited. Under NRO Non PIS, you can trade F&O, you can do intraday trading, which became possible for NRIs only from July 2025. You can build a much more active strategy if that's your style. So it's not just cheaper, for active traders, it's structurally more capable. Again, I'm not promoting F&O and active trading, but people who are into it, this makes a huge difference. Benefit 3, I want you to hear this clearly because this is where bad NRI advice usually breaks down. Under PIS, your bank tracks your holding daily and reports them to the RBI. It's tighter bank level monitoring of how much you hold in any one company at any time. Under non-PIS, that bank level monitoring layer goes away. But the broader RBI and SEBI company level caps still apply. An individual NRI can hold up to 10% of a listed company's paid up capital. All NRIs together can hold up to 24% in aggregate. These are FEMA rules. They apply whether you're using a PIS or non-PIS account. So don't assume non-PIS means no ceilings anywhere. Think of it as a fewer bank level reporting steps, but same underlying FEMA caps. If you look at it, for most individual NRI investors, including Rajat, these caps are irrelevant in practice. You are never going to hold 10% of a listed Indian company, but this is the kind of nuance that separates a good advice from a misleading one. Benefit 4, important caveat first. The USD 1 million per financial year repatriation limit isn't a non-PIS rule, it's a general FEMA rule for any NRO account. Since NRO non-PIS sits on top of an NRO account, that same USD 1 million annual cap applies, subject to applicable taxes and documentations like Form 15 CSCB, which is now Form 145 and 146 under the new Income Tax Act. So here's the real trade-off. Investments through NRO non-PIS are on a non-repatriable basis within the USD 1 million per year limit. If full repatriability matters to you, meaning you want to freely move everything back abroad without any cap, NRE PIS is still the cleaner route. But for most individual NRI investors, USD 1 million per year is more than enough. And within that limit, repatriation is simpler because you're not routing funds back and forth through a separate PIS ledger. Benefit 5, because an NRO non-PIS setup is fundamentally an NRO account, it naturally becomes a consolidation hub. Rental income, dividends, pension, investment flows all in one place. It can actually receive remittances from abroad which get converted into INR on credit. Instead of tracking multiple sources across multiple statements, you have got one clean view. Tax time becomes simpler, fund tracking becomes simpler. This is what Rajat's cousin realized 2 years ago. Everything flows through his NRO non-PIS setup, rent, dividends, trading, one account, one statement, one view, which is why when Rajat asked him, how do you keep track of all this? His cousin laughed because he doesn't need to. Let's look at NRE versus NRO account also. Clarity here is important on account types because this is where most NRIs gets lost. NRE is for foreign income, tax-free interest in India, fully and freely repatriable. NRO is for Indian income, rent, dividends, pension, sale proceeds, interest is taxable with TDS. Repatriation capped at USD 1 million per financial year. When people say non-PIS in NRI trading, they almost always means NRO non-PIS. That's the standard route brokers provide. Through NRO non-PIS, an NRI can do secondary market, equity delivery, F&O, and since July 2025, equity intraday. SEBI's NRI specific restrictions still apply. Short selling generally isn't permitted for NRIs. Leverage rules can differ. So please confirm specifics with your broker. If you specifically want fully repatriable equity investing, then NRE PIS remains the route. Non-PIS trading is an NRO story. And for mutual funds, here's the part most NRIs get wrong. You don't need a PIS, you don't need even a non-PIS either. Mutual fund investments for NRIs flow directly through your regular NRE or NRO account, folio based with standard NRI KYC and FATCA. So, if mutual funds are your main focus, the simplest path is often just your regular NRE or NRO account with the fund house directly. Rule of thumb: foreign income sits in NRE, Indian income sits in NRO, fully repatriable equity goes through NRE PIS, active cheaper trading goes through NRO Non PIS. Mutual fund needs neither. Screenshot that one summary is worth the entire video. Now that out of the picture, 3 misconceptions worth cleaning up. Myth 1: non-PIS accounts aren't safe. Not true. The NRO account underneath is fully regulated by the RBI under FEMA. Strict KYC norms apply. You're not in a grey zone. Myth 2: you can't invest as much through non-PIS. Also not true. Through NRO non-PIS, you can actually invest in equity delivery, F&O, intraday, IPOs, convertible debentures, bonds and warrants. The universe is broad, just structured differently from PIS. Myth 3: tax is more complicated with non-PIS. Reality check: tax rules for NRI investments apply regardless of whether you use PIS or non-PIS. If anything, with fewer moving parts, your transaction trail is cleaner. Yes, interest on NRO accounts attract TDS, but that's how NRO works across the board. Nothing to do with non-PIS. So, is non-PIS for everyone? Not necessarily. If you trade actively and want a leaner, cheaper setup, NRO non-PIS is a serious upgrade. The cost savings alone can justify the switch. If you want F&O or intraday trading, NRO non-PIS is essentially your only option. PIS doesn't allow either. But if you have multiple streams of Indian income, the underlying NRO account naturally consolidates all of it. And if PIS friction has kept you on the sidelines of Indian investing, this is the lower friction path. But on the flip side, if you specifically need fully repatriable equity investments, freedom to move everything back abroad without the USD 1 million cap, NRE PIS is still your route. If your focus is only on mutual funds, you don't need non-PIS at all. Regular NRE NRO account handles it. And if you're running business transactions, those generally need different FEMA structures. A personal NRO non-PIS isn't the right tool for business income. Let's look at joint accounts. I want to flag this because I've seen this misstated in books, blog posts, and even by NRI consultants. NRE accounts can be held jointly only with another NRI, PIO, or OCI. A resident Indian cannot be a joint holder on an NRE account. But NRO accounts can be held jointly with a resident Indian close relative, typically on a former or survivor basis. The NRI is the primary holder. Since NRO non-PIS sits on the NRO side, you have this joint holder flexibility at the banking level. Banks and brokers can have their own policies on the linked trading and demat accounts, so always confirm specifics. This alone can make estate planning and family operational management dramatically easier. Most people don't realize it's allowed. Now let's look at 4 last practical points. 1. NRO and NRE accounts are in Indian rupees. They don't hold foreign currency balances, but you can definitely absolutely receive inward remittances from abroad. They just need to get converted to INR on credit. 2. Minimum balance varies by banks. Check before opening. 3. You can hold both a PIS account and a NRO non-PIS trading setup at the same time. That way you can segment repatriable and non-repatriable investment. 4. Non-PIS isn't mandatory, it's entirely optional. But for a growing number of NRIs, especially active traders, those who want a simpler setup, it's becoming the default. Precisely because it gets out of your way. So here's the big picture. Non-PIS isn't some exotic instrument reserved for high net worth NRIs with teams of advisors. It's essentially your regular NRO account linked to trading and demat account used in a way that skips the PIS reporting layer. That's it. Regulated, legitimate, and quietly saving active NRI traders between 50,000 to 2 lakhs a year. Think about Rajat, 4 years of PIS, 200 rupees per order, daily reporting, lag on fund movement, no intraday, no F&O, all unnecessary for his actual investment style. And 1.2 lakhs in unnecessary cost. Don't be Rajat 4 years ago, be Rajat today. Ask your bank about NRO Non PIS specifically, ask about the fee difference, get clear on the tax implications and the non-repatriation caveat for your situation, and then decide. Remember, the Indian market isn't slowing down. The question is whether your banking setup is keeping pace with your ambitions or quietly costing you lakhs while you are not looking. If this video made you rethink how you are set up, drop in your comments. I read every single one. And if you still have questions, drop those too. I'll personally answer them all. And if you know of an NRI who's been trading in India for a few years without thinking about this, do them a favor, share this video. You might save them their own 1.2 lakhs. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thank you for watching, and I'll see you in the next one.